Bank of America, Morgan Stanley, Charles Schwab are the standouts today. Half of the companies in the S&P 500 that have reported earnings in the past week are in the financial sector, giving us a good glimpse at the consumer. This is according to FactSet. So let's talk a little bit more about the results we've seen so far. What it signals going forward. For that, we want to bring in Tom Hayes, Great Hill Capital Chairman and Managing Director. Tom, it's good to see you here. So the Q2 setup was similar to what we saw headed into the first quarter. Now that we've gotten even more results this morning from Bank of America, from Morgan Stanley, I guess what are your big takeaways just in terms of the health of the consumer and what it signals?
Better than expected. The bar was very low, and as we know, the secret to happiness in life is low expectations. So we came into Q1 negative 6.2% expectations. We got -2. Analysts had to take their numbers up. The strategists were looking for a drop of 20% in earnings. Instead, we got a rise. The same exact thing. We expected negative 7.1% coming into this earnings season. We're shooting the lights out. The average gain over the last 10 years during earnings season is plus 5.3%, which means we could finish up negative 1.7%, and that's going to force analysts to take their guidance up. And if we look at the next 2 quarters, even now the guidance is plus 0.1% for next quarter, so positive earnings next quarter, and then plus 7.6% for Q4. So a lot of good things coming, but I think they're coming right now.
Tom, give me a sense of what your read is on where we are in this economy right now, based on the numbers that we've gotten so far. I mean, you heard Brian Moynihan earlier saying, look, the consumer has been a lot more resilient than we expected. The economy is still fairly strong, even though things are starting to slow down. What's your read based on the earnings we've gotten so far in terms of where we're headed?
Well, you have an 80% beat rate, Akiko, and you have to keep in mind, people talk about negative money, M2 money supply growth. You had basically 10 years of money supply growth pumped into the economy in 24 months. So that's going to take a long time to work off. And I think that the pessimism is overdone. It's been overdone. Granted, we're up over 25% off the October lows, so we might have some consolidation. But that consolidation could actually look more like rotation. So while the indices may not quite do as well as they did in the first half of the year, being up mid-teens, maybe we'll get mid-single digits to high single digits. Underneath the surface and underneath some of the sectors that haven't participated, and we've talked about the Magnificent Seven, they've started to participate in the last 6 weeks since I've been on, which we talked about last time. That's where the opportunities are going to be. So if you're just jumping into the indices now, you may not be that excited to get 5 or 7 or 8%. But if you're jumping into the 90% that didn't participate the first 5 months of this year, there's huge opportunities. There are going to be stocks up 30, 50+%.
Tom, the beat rates that we've seen so far, is that enough, though, for the market's momentum, this rally, to stay intact? Or are we going to have to see maybe some stronger results elsewhere, economic data that's cooperating with a cooling economy, maybe for the Fed to back off in order to keep that trajectory to the upside?
Well, people were pretty pessimistic coming into the bank earnings. Other than the revenue was supposed to grow 7.8, which was going to be the highest, people worried about net interest income. That's proven to be better. I love what Brian Moynihan said about commercial real estate. People have been so pessimistic that this was going to blow up the economy. And instead, he's like, it's a building by building thing. It's going to work itself out. And these are going to be extended. They're going to be renegotiated. And it's going to depend on the different buildings. The A class are going to do exceptionally well. The B and C class properties, they'll work out and they'll restructure. So a lot of positive things happening. So I think the key is not being tempted with FOMO to chase the things that are up enormously already year to date and look at those things that haven't yet fully participated, because that's where all the money is going to come next. And actually, if we looked at the Bank of America Global Fund Manager survey this morning, it was so interesting. In the COVID lows in 2020, the institutions were so skeptical. After the market rallied from March till June, and it just took off, they still wouldn't get in the market. They were still pessimistic. They were still at high cash levels. Guess who bought those first 4 months? Retail investors got it right off the COVID lows, and it's the exact same thing is happening right now. The retail investors have been buying. The sentiment has gone up. Institutions actually picked up their cash levels this month. They're still overweight cash and bonds. They have the least risk on since the COVID lows and since the great financial crisis lows. Their growth expectations are still pessimistic. So that is further fuel for this market to churn higher on the indices level, but actually for the laggard groups, that's where they're going to have to chase. They're not going to chase what's up if they're already missing their benchmark. They're going to chase those things where there's opportunity.
Tom, we're a week out from the next FOMC meeting. When you think about expectations right now, nearly unanimous in terms of expecting a rate hike in July. Just under 3% think the Fed will hold to a pause. Based on the data that we have gotten since the last meeting, are you in that camp that this is the meeting where we have a hike, but maybe see a longer pause on the other end of that?
Well, Akiko, are you asking me what they should do or what they will do? Those are two different questions, but both are great questions.
What they should do.
What they should do is they should absolutely skip once again and say we're going to look at the data, because they have more than enough cover at this point to justify a skip. When you look at PPI, that was near deflationary levels, up 0.1%. That leads CPI. CPI was a tick off of a 2 handle, and we're still thinking about hiking rates. These things worked on a lagged basis. Between PPI and CPI, they have more than enough cover. You had the lowest job growth with the non-farm payrolls at 209,000 jobs created. You have the U6 unemployment rate at 6.8%. So the lagged effects of the tightening that have been going on for over a year are being felt. Now they just need to sit back and make sure that trend persists and make sure the data keeps going down. So if I was in Jay Powell's shoes, I would say skip, let's see more data, and ultimately turn into a pause. They probably won't do that because it's priced in. The market can handle another hike, but they shouldn't go too far beyond that, because when that lag kicks in, it tends to get aggressive. And right now they've landed this soft landing opportunity, and they could ruin it if they get too aggressive and too feisty.
So if they do 2 more hikes, the odds of a soft landing
go down materially.
How significantly?
Yeah, it's. I think you'd go down from a 95% possibility of a soft landing to maybe a coin flip.
The data that the Fed should be looking at, obviously inflation, CPI, core CPI, is what they're most closely watching. We've gotten to, on that headline number, not core CPI obviously, but that headline number, to 3%.
Yep.
If we want to see further cooling in inflation, how do we get that? How do we make more progress if the Fed is not going to continue to hike? Or they shouldn't, in your view?
We can't afford to see more disinflation because we have 120% debt to GDP. So the last time we had this much debt in debt service, as you saw the headlines, debt service is now approaching $1 trillion a year. That's huge. Last time we had debt to GDP at 120% was following World War II. And the way that they got out of it was through nominal growth. They let inflation run between 3 to 5% for 5 years. And debt to GDP collapsed from 120% down to 63% in just a handful of years. That's the playbook they should be following right now. Acknowledge that, continue to talk hawkish. We're going to take it down to 2%, but let it run a little hot so we can bring the debt to GDP down and have it at sustainable levels, have nominal growth run hot, and all will be well. So hopefully they're following that playbook and they're reading enough history books to continue. They've got a win here that, don't snatch defeat from the jaws of victory. They got a clear win here. Skip it. If they won't skip it this month, then just go into a pause after this month would be great.
Tom, we started by talking about the banks. Financial is one area that has really benefited from the Fed's rate hike cycle, obviously, because of the income earned on those rates. There's another area, though, that's been hit hard by the Fed's hiking, and that's REITs. I mean, what's your investment thesis around that right now?
Okay, so great question, Akiko. There are 2 themes that we're looking at now that the Fed is wrapping up. Whether they should have wrapped up at the last meeting, so they'll wrap up at this meeting. Number one, the dollar downtrend that began in October is going to continue. Okay, so that's already happening. We had a short bid to safety in advance of the debt ceiling just a few weeks back. That's now rolled back over. So with the dollar weakening, we like multinationals that get up to 50% or more of their income from abroad. Those increased earnings are really not baked into future estimates. We're going to start to see those come through in the second half of the year. We like emerging markets is going to work with a weak dollar. Emerging markets, China, and risk on with biotech. Now, as it relates to REITs, the second theme besides weak dollar is that we're going to see the middle end of the curve to the long end of the curve, the 10-year, start to get bid, which will compress rates. That helps a number of things. That helps regional banks with their mark-to-markets. That helps REITs start to get bid because they're interest rate sensitive. And I know we were on a couple of months ago talking Vornado, and people looked at me like I had 3 heads, but they were kind and polite. And Vornado's up now 30, 40% since then because the high-quality businesses will do well. The B and C properties we're not so sure, but the A properties are going to do well. This is very similar to the mall crisis of 3, 4, 5 years ago, where everyone said all these malls are going out of business. The B and C properties did go out of business. The A properties, like Simon Property Group, that have Apple, that have Lululemon, did exceptionally well. We think it'll be the same case for commercial real estate REITs with A-class properties like Vornado, which we own.